starting this new year with an interesting video on a topic which I think will play an important part in how markets really continue from here. And the question really came up on Twitter when somebody was pointing out that bond yields went up and Nifty went up together in 2011 or 12 or 13, and why should we really bother about bond yields? And so that became central because recently, if you saw my last video and podcast, I have spoken about the divergent trends in interest rates between US and Europe and Japan really coming to a close. So the divergent trend was that US was raising rates, the others were not, and that was causing the dollar to strengthen excessively. Now, US is slowing down its rate hikes and Europe and Japan are stepping it up. So that is actually causing the dollar index to slow down its advance, and it could slow down lower the volatility in the DXY, though it is possible it still advances eventually. But in the meantime, when we actually look at the DXY, we want to see the underlying cause. And so if the cause so far was rising rates, the question is, are rates still rising? And the funny thing is, because the DXY is nothing but a cross rate, right, between two currencies. But if everybody is raising rates, the underlying factor, which is tightening liquidity conditions, doesn't really go away. And so it was important to look at how does India do in that respect, because we look at the 10-year G-Sec. So that is what I've put on this chart. I'm not looking at US yields, I'm looking at Indian yields, the 10-year G-Sec and the Nifty. How have they correlated over time and what does it really mean? So like in every market, if you lower rates, you somewhat stimulate the economy. That is true even for India. The only thing is the point at which it works, so there's always a lagged effect. There's not like an immediate effect. India bond yields actually peaked somewhere in 1996 when the economy rolled over, and there was a lot of inflation for a while from the previous cycle's effect. And then once that effect went, rates started to come down. So they came down from a peak of almost 14-15%, slowly down to what you can see on this chart is only around 12.5%. In sometime in 98, because there's no data prior to that. And then they continued to decline all the way down here. You can see the 10-year falling to almost 5% after the Y2K bubble. So this is the Y2K crash here at the bottom of the chart, what you can actually see. So let me highlight it. This is the Y2K crash, and during this entire period, yields are going down till this point. But yields are still being cut. They're being cut, they're being cut, they again cut till this point here where it actually starts to stimulate the market, and so the market starts to go up. Okay, so this is how it happens. The market turns around after a lag. It doesn't, like, moment you start cutting rates, it doesn't really happen. Now similarly, if you're raising rates, which is usually after the economy is turned and there is strength, so as the economy is getting stronger, the markets are going higher, yields with a lag keep going up, keep going up, keep going up. But there's always a cutoff point beyond which the market can't take it. It's gone too far. And so what is that cutoff point is what we are trying to really, get at. And so that's what I'm going to point out here. I've drawn a line already. This horizontal line here is at 8%. Okay. What I observed is that is sort of close to the cutoff point where it creates, panic on the street. Okay, and then if it cools off from there, then eventually things improve. So let's look at that thesis now more closely. Here's a point where rates were rising into a strengthening economy. Till this point of time, remember, this is exactly where oil prices went in June of 2008. Oil prices went to $135, and that forced the Central Bank, Reserve Bank of India, to raise rates, and actually try to fight some of that inflation that came because of oil. And so this is the spike you're seeing in bond yields all the way to around 9.38%. So they went above 8% to 9.38%, and all this happened from here as the market started to fall. Now, of course, once the market was broken, it continued to fall much more, and we started the process of cutting interest rates. Right? That's the whole point. You need to cut rates to stimulate. And so how do we really do that? So let me just see, I'm looking for a coloring option. It's not really giving me. Let's see, maybe this will work. So, what we are looking at is here, we started to cut rates. Okay, so I'm using a different highlight. Okay, so this cutting rate process starts. It doesn't really stimulate till much later points. The cutting rates have started here, and then somewhere at some point the market bottoms out, and eventually both the market is going up and yields are going up. In fact, we ended up with double-digit inflation as we headed into this. Inflation was almost 18% because of the stimulus. 20,000 crores they put out, to bring the market back apart from cutting rates, and it had the other effect. Now again here, note that the crisis period is here as interest rates really crossed the high. Okay, so here once again we go into a different mode. Okay, moment interest rates cross this 8% high, markets have started to go down, which is what I've highlighted here with colors. This is a region where rates went above 8%. So market had fallen, and then yields are really high at this point of time. So a lot of the crisis periods have been associated with yields being over 8%. Now, and like I said, there's a lead lag. So prior to that, there's no effect. Okay, so when the markets are improving from the bottom and yields start rising, for a long time there is no effect, and that is why it looks like, well, rates are going up, equities are going up. What's the problem? The problem is only if yields get too high is where it's a problem, because then borrowing slows down, credit growth slows down, and that then affects growth itself. So this is the basic thesis I'm going with, and so let us now look at that over time, right? So let's just squeeze it in. This is what yields have done since the boom started in 2003. After the big drop in yields that we had here, okay, we've been inside a very, very broad triangular pattern. I'm calling this a triangle. In Elliott wave, it's A, B, C, D, E. I thought maybe E ended here, but based on this falling channel pattern, what I've been increasingly thinking is that because yields did not fall further below 5.8, that maybe we are still forming a triangle, which means we are in the final leg of this yield expansion, and that will probably end at some point of time. So the yield expansion could actually, take us to closer to maybe this upper line, which is near 9% or a little higher. And so that's my end result expectation. But because we've drawn this falling channel, this is working as a resistance since the start of 2022. Okay, so even as Indian yields have moved up with the rest of the world, we aren't above 8%. So we're not at crisis point, which is what all of these are associated with. Note this point. People say there's a very short, brief bump above 8%, but that's exactly where the mid caps topped out over here. That's also close to when we got the the ILFS crisis. Okay, so it looked like, yields had spiked because of that, and the mid cap sector entire peaked out. And here throughout this period, even though the Nifty is sort of flat and attempted to make a higher high, the broad market was continuously falling, making lower lows all the way till 2019. 20 this is, and then after that the last leg down because of the pandemic. Now so this whole fall occurred after we crossed 8% on the 10-year GSEC, right? So this is how it has been. Here also this jump in yields is associated with this small little decline here. It's not big, but that's when the rupee went to 69, from 50 something to 69. The big move occurred while yields had gone up. So yields actually moved up to save the rupee, you can say, whatever may be the cause, but they had to go above 8%, and the market took that slight hit over here. So the size of the hit may vary depending on, whether you're in a big bear market, 2009, small consolidation, retracement, 2011-12, brief correction, 2013, or again, big decline, 2018 to 2020 in the broad market, which sort of brought a lot of stocks down, even though the Nifty didn't reflect it till the pandemic. So each scenario different. The question is what happens now. And so the way I've been looking at this is that if we have actually completed a large ABC, and if E was not over at this top, then most probably this is D and we are still forming E, in which case prices need to go there. But what we need is some confirmation that the final leg of a move above 8% is coming. And so that confirmation comes when we break out past this line. This line is close to around 7.5%. That's been the broad range. Like I said, we've been trading inside this consolidation range for the 10-year GSEC yields, and we've really not broken out of it. Currently, the range is around 7.2 on the lower side and around 7.5 on the top side. Once we break out of this range is when we'll make that leap. So that is what I'm thinking. And possibly markets will get worried. I don't know whether on this breakout itself or maybe as always, somewhere above 8%. But as we've seen in some of the cases, the markets had already peaked prior to reaching 8% here. Prior to this breakout, it had already peaked out here, just as we were pushing above 8. Here also we peaked out here before the final spike. So this part happened before the final spike, and so there can always be that slight variation. So you can draw a line and see where yields were. They pierced the 8% point once or twice at this point of time, where you had this 2006 correction just before that. So there's a lead lag again. Here also before there was a slight correction in 2007. So you did have those, but not significant. The big one is where the markets rolled over because of the global financial crisis. So in any case, it doesn't have to be exactly timed that exactly when you go above 8 this happens. But the point is, if yields are rising, specifically 8% is a recognition point. Above that, everybody takes note, because usually as 10-year G-Sec's been below that level for so long that most people may ignore it till that point of time, or might not even think that we can get this breakout. So which is why it's going to only get noticed when it happens. My sense is because of the falling channel, and because you have done an ABC down, the chances are we break out of this channel. And so I'm only waiting for the trigger point. Whenever we get this trigger point, this zone, these two breakouts, I think that's when markets actually take note of the yield impact of rising interest rates starts to show up on the Nifty. So this is the thesis. So whenever people think that rising rates have been associated with a bullish market, that has to do with a very, very different period and different phenomena. It's the recovery phase. It's after rates went down, okay, which is what happened over here. So I'm putting that in yellow. Okay, when rates went down and stimulated the economy, that's sort of the point at which we start seeing rates turn around and markets start to recover. So as markets recover, rates bottom out and start rising as well. That's sort of how it happens. And so rates are usually leading or lagging rather the stock market itself. Stock market bottoms much after rates are cut and then peaks out after rates have started to rise, and so markets lag the interest rate environment, and that sort of is what the bond, equity, commodity cycle is also all about, right? Bond markets tend to lead. They're the first ones to bottom out and the first ones to top out. Equities are second in the cycle and commodities are third in the cycle. So that's sort of the map of the business cycle, and so we always see that. We see commodity prices peaking out last in 2008, similarly bottoming out along with equities much after the bond market. The bond market is always the first. When it bottoms out, rates start going down, and they start going down much before the market. Equities are still falling while rates are going down, and then at some point of time, both of them start going in the same direction. And then here the bond market turns down even as equities are going up, which means bond market turning down means rates start going up. So rates are going up, the market is still going up till the point where rates have gone up a lot, and then both start going down together. So this is that's the bond, equity, commodity cycle theory. Here we are purely looking at how the 10-year G-Sec in India and the Nifty have behaved with a lead lag. So the bond market is always ahead, Nifty lags behind, and right now what we are seeing is, yes, rates have been going up and Nifty has also been going up. We did see some impact of this rising rate here when it was in the final stage. It caused the market to fall. But the moment it's started to consolidate and it's not looking like going above 8% yet, the market has taken a breather. That's sort of how we can justify our current situation purely on a bond market perspective. But if rates start to rise and break out of this range, I sense markets will take note, especially at the 8% point. 7.5 will be the first point at which I will definitely be making noise. But 8% is where I think everybody else will start making noise. So that is just how it's going to be. So that's it on this update. Hope you got an insight about how these interrelations occur. What is the important level for bond yields? Eventually, of course, given that this is a large triangle pattern, I wouldn't think rates go far away beyond 9%. So for some people, 9% is also a dream. But to me, that's part and parcel. So essentially what I'm saying is that rates go up here, but you cannot rule out an overshoot sometimes. I don't know if it will overshoot or not. Overshoots in triangles usually top out near the previous high, so you will not go above the peak we made back here around 9.2 or something like that. So that may be the maximum overshoot, if at all. Otherwise, close to 9% they peak out and roll over. In fact, this line on the trading view chart is at a different level. Investing, it comes closer to 9. Here it's showing 8.72. So I'll say somewhere between 8.7 and 9 is the broad range where yields really peak out and complete this triangle pattern. And completing this triangle pattern simply means completing wave E of a very large structure, which should be the last up move for yields for a long period of time. So that's it in this update from me. Thank you.